It would have taken a brave investor at the start of 2025 to bet that the FTSE 100 would outperform the S&P 500, but that's exactly what happened. You mean the index with the boring bank stocks beat the index with the exciting tech stocks? Crazy, right? If only that was the craziest thing that happened last year. In fact, the FTSE 100 enjoyed its best year since 2009. In the last year, with dividends included, it's performed over 25%, compared to the S&P 500 returning just over 9%. But since 2010, it's not been comparable at all. But was 2025 an anomaly, or is this the start of a new era? Some of that difference is down to exchange rates. GBP USD started 2025 around 1.25 and is now sitting around 1.34. Over 7% up. But whichever way you look at it, there's still been an outperformance. This has surprised a lot of people, and I think a lot of that is down to the massive disconnect between the economy and the stock market in the UK. And I think that's why a lot of people will look at the state of the UK economy right now and then look at 25% growth in the stock market and wonder how that's possible. But what's unique about the FTSE 100 is just how export heavy it is. Around 75% of revenues are generated abroad. I mentioned earlier about the pound and the dollar exchange rate increasing in 2025, and that was predominantly down to the US dollar falling in value as opposed to the pound increasing in value. And we can see that when we look at the pound versus the euro. At the start of 2025, the GBP euro exchange rate was sitting around 1.2. It then fell around 5% to currently sit about 1.15. And this is important because of how export heavy the FTSE 100 is. When the pound falls in value, it makes exports cheaper and therefore drives more sales. And Europe is one of the largest importers of UK goods. So you tend to get this inverse relationship between the pound and the FTSE 100. When it comes to valuations, the UK could be seen as relatively cheap compared to the US, which has seen valuations soar with the rise of big tech. With the outperformance of last year, this gap has been slowly closing, and the UK stock market currently has a PE ratio of 19.85, compared to the last 5 years where it had an average range between 10.42 and 15.67. Looking back in history, we can also see the last time the UK's PE was this high was back in the early 2000s. The US stock market is still higher with a PE ratio of 27.11, but it is slightly closer to its 5-year average range, which sits between 20.09 and 24.75. And while that gap has been closing and it's likely that it could close even further, there is still a valuation gap there. And that can be explained by the type of companies in each index. On one hand, you've got high growth tech companies. On the other, you've got mature dividend paying companies. Tech companies will typically reinvest their profits back into the business for higher growth rather than pay that out to shareholders. And we can see that when we look at dividend yields for these funds from iShares, with the FTSE 100 currently sitting around 2.94%. And the S&P 500 sitting at 0.93%. And I believe that the expectation that there's going to be a cooling off in the stock market has led to higher dividend-paying stocks being more preferable. It's that concern about frothy valuations from US technology stocks that's precisely what's drawn investors back to some old-school industries like banks, miners, and defense stocks. And that's exactly what the FTSE 100 provides, along with some pharmaceuticals and consumer staples. But in terms of investing into one of these indexes on their own, they're not exactly what you would call diversified, even though in the past that's exactly how they were marketed. One of the big selling points for the S&P 500 in the past is you get 500 stocks across a very diverse US stock market. It was a very hands-off and passive approach, but some of the more recent criticisms have pointed to the top 10 now making up around 40% of the index. Not only that, but it's very concentrated in the technology sector, around 36% of the index. The FTSE 100, on the other hand, you would expect to be slightly higher concentrated, just simply being less stocks, only 100 compared to 500. The top 10 in the FTSE 100 makes up around 46%. You could argue, however, it's slightly more diversified by sector, with the highest weighting coming from financials at around 22%. And a lot of attention is given to this concentration risk, and rightly so. It's an important factor to take into account. But you could look at it both ways. On one hand, you could say that it's not diversified and you're putting more and more focus and emphasis on a smaller handful of stocks. But on the other hand, a market cap index is doing its job. The more a company outperforms the others in the index, the further it moves up the chain, the higher weight it gets in that index. And that means the higher performing companies then get a higher weight within the index. And as a passive investor, that's exactly what you want, more of your money going towards the winners. Of course, that's generally only a good thing when companies are all moving in the right direction. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. But for 2026, I think this is one of the hardest years to predict in recent history. Not that any year is usually easy, but I think there's so many things that can play out over the course of the year that can affect what happens to the stock market. It's positive that we'll likely see further continuation in the reduction of interest rates, and that can only be a good thing for stock markets. Inflation as well does finally seem to be on its way down, and as long as that stabilizes and there's no shocks or spikes, then again, that should be a good thing for the stock market. I also think commodities will play another big part in the stock market this year. There's already enough supply of oil in the world that data that's making investors neutral to bearish on oil. And it's far too early to tell exactly what's going to happen with Venezuela, but it's likely over the next few years that we could see oil supply increase even more, and therefore putting more downward pressure on the price of oil. And that in turn could be good for businesses and consumers. Everyone does seem to be predicting the extremes. Either the stock market's going to do another 20% or it's going to crash 20%. There doesn't seem to be many opinions and articles just sitting in the middle. Maybe we get a bit of a cooling off in the stock market. Maybe it only does 4 or 5% for the next couple of years. That would actually help to bring the recent returns closer to its long-term averages, but without having to be a dramatic correction or a crash. All you can do as an investor is to stay consistent, stay invested, and not make emotional decisions based on stuff you read in the news. Let me know your thoughts down below in the comments. I hope you found that useful, and I'll catch you in the next one.